The stock market in the short term is driven by greed and by fear. And the fear thus far this year has created a lot more volatility than we've seen the previous 6 months. The question is, are you using that volatility to your advantage? If not, how can you take advantage of this stock market volatility? I've got 3 ways that more coming up. Volatility is a feature of being an investor. It's not a bug. I know at times when the stock market's going haywire, often in the wrong direction, it can feel like, what's wrong? Something's got to be wrong here. And yet, unfortunately, that is just a normal occurrence in the stock market. It's not every day, it's not every week, month, every season, but it is normal. As a long-term investor, there are definitely time periods when the stock market is going to be very, very volatile. And so recognizing it first and foremost that no, this is just part of being an investor, we're going to stay the course, that can help you keep your emotions in check. Because those emotions can lead you to what will feel like a really rational decision to make some big changes in your market, in your investments until this all blows over. But oftentimes those emotions can lead you to make decisions that are actually detrimental to your investment strategy and your performance over the long term. Even though they feel very rational, they actually can undermine the progress that you're trying to make. And at the root of that fear is not knowing. Well, is this volatility going to lead to a big downturn or not? History has revealed that, the stock market tends to have a decent amount of gyrations at different periods during the year. And eventually, typically give it a little bit of time, the market will work itself out. That crisis felt like a crisis was averted, or maybe the can was kicked down the road and the stock market goes on to smooth sailing. Occasionally, though, it does happen where the stock market, that volatility leads to much deeper volatility, right? It gets a lot worse before it gets better. And we don't know. That's the uncertainty that you live with as a long-term investor. The question is, how do you harness that volatility? How do you use it to your advantage? Whether this is just a short-term blip or it does get worse before it gets better. What's your strategy to leverage the volatility? You've got to use it strategically. And the first one is you've got to use the volatility as a buying opportunity. You've got to use it as a buying opportunity. Dollar cost averaging. You may have heard that term before. This is where you're investing a regular amount at regular intervals. So think of your 401k. Every single paycheck, you've got money coming out of your 401k, out of your paycheck going into your 401k, and those dollars are buying shares, okay? When the stock market is going up, that same amount of dollars, that contribution amount that is fixed, it's the same percentage out of every paycheck, is buying fewer and fewer shares because the price is getting higher and higher. Well, the opposite is true, and this is where it can be used to your advantage. When the stock market's going down, the same amount of dollars are buying more shares, right? The shares are on sale, if you will. If only it felt that way, like it does when we go shopping. But you're buying more shares because they're cheaper. Your dollars are going farther, and dollar cost averaging is looking at that over some volatility over a certain period of time. When you look at the average price that you bought those shares at, you bought more shares during these bouts of volatility. So use it to your advantage, leverage dollar cost averaging. We haven't seen, we saw the tariff tantrum about a year ago, but we haven't seen a long period of volatility since 2022. And one of the most common comments that we got here from the community on this channel is, I'm going to stop investing. I'm going to wait until things get better or when it feels safer, and that's when I'll start investing again. No. That is not using the volatility to your advantage. That's not being strategic with it. Stay the course, continue to buy. You're buying more shares. It's almost like you want the stock market to go lower while you're buying. That's the way you can use this volatility to your advantage. Second is you've got to rebalance intentionally, not emotionally. Rebalance intentionally, not emotionally. If you are diversified, then you don't have all your eggs in one basket. And it's very, very common. I would say it's natural when you're reviewing your portfolio to look at those different baskets, to look at those areas that you have your investments in and say, well, which ones have done the best? Oh, those are the good ones. Which ones have done the worst? Those are the bad ones. I need less of those and I need more of those. That's what our emotions lead us toward. However, rebalancing is about looking at your entire portfolio and, what's the right recipe? What's the right mix? Not just for your investments, but for your plan. What's the right overall diversification mix for you to achieve your financial goals and your financial plan? And when we see these bouts of volatility, it's very possible, in fact, likely, that the formula, that the recipe gets a little out of balance. Rebalancing intentionally at these times of volatility can help you sell high and buy low. For example, now the stock market at the time I'm recording this has gone down a few percent. Bonds have been a little shaky as well, given that, interest rates and mortgage rates have gone up a little bit. But let's say during some volatile times, your bonds have held up all right, but your stocks have gone down in value. And therefore, your 80-20 portfolio, you now have about 22% in bonds and 78% in stocks. Well, you can sell some of those bonds at a high point, say, and buy some of the stocks. Therefore, you're selling high and buying low. Rebalancing helps you do so unemotionally. Unemotionally, you can do so intentionally and use this volatility to your advantage. And then lastly, be opportunistic when it comes to your taxes. Be opportunistic when it comes to your taxes. Stock market volatility can open the door for a lot of tax planning opportunities that only exist during these, quick moments when the stock market is going down. One of them could be, well, if you're planning to fund your Roth IRA this year, or if you're planning to fund your HSA this year and you're shoeboxing your HSA, investing it, and you've got the cash available, the stock market goes on sale, drops 5%, drops 10%, that might be the perfect time to say, okay, I'll just make my Roth IRA contribution right now, right? Oftentimes, 3 out of every 4 years, the stock market's positive. So we try to coach people, well, if you've got the resources, make that Roth contribution, your HSA contribution at the beginning of the year. Not a lot of people financially are able to do that. But if you're building up the cash and we see a downturn in the market, go ahead and make that tax shelter contribution at that moment. Another tax opportunity is tax loss harvesting. This is outside of your tax shelter. So you've got an individual investment account, a brokerage account, if you will. If you've got some investments in there that maybe you've been feeding and they've been going up, but all of a sudden we see the stock market drop 10% or so, you might have a few losers. Now, they might be part of your overall diversified portfolio. And yeah, I don't want to sell that, but you could sell that specific investment, capture a tax loss that will benefit your tax picture or offset future gains, and then buy back a similar investment that if we do see that area of the market rebound, you're still in great shape. Being strategic about tax loss harvesting can significantly improve your overall cost basis over the long term and improve your taxes as well. And finally, a tax opportunity that we talk about a lot is the Roth conversion. And I get it. Yep, if you are going to withhold taxes on a Roth conversion, then it really doesn't matter whether you're doing it at the, after the stock market dropped or when the stock market's at a high point. We don't like withholding taxes on Roth conversions. If you need to, okay. But if you've got other resources, maybe you've got a tax refund that you say, you know what? Instead of withholding taxes on this Roth conversion, I'll just have less of a refund. I'll just have the Roth conversion eat into some of my refund. And the stock market's dropped 10% or 15%, doing a Roth conversion then, that even if the stock market, it gets worse before it gets better, when it eventually does get better, that growth will be growing tax-free because it will be in the Roth. Those are 3 ways that you can use volatility to your advantage and be strategic about it. Be a buyer. Be a buyer through that volatility. Rebalance intentionally, not emotionally, and be opportunistic when it comes to your taxes. All of those is part of taking a comprehensive look at your financial life, looking at all 6 areas of your finances so that you can bring synergy to those areas. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.